You work harder, but you fall further behind. Your money buys less. Your savings are losing value. This is not random. It is an outcome of the financial system we now live in. That system's operating code was rewritten on a quiet Sunday evening decades ago. That was the moment money was severed from reality and ownership was replaced by abstraction. This is not a history lesson. This is an explanation of the machine that quietly runs your life and the design flaw that is now threatening its stability. To understand the failure, you must first understand the original design. Before 1971, the global financial system operated on a simple physical agreement. The US dollar was a claim check for gold at a fixed price, $35 for 1 ounce of metal. Any nation could exchange its paper dollars for real gold from the United States. This created hard limits. A country could not print money infinitely without triggering a run on its physical reserves. For the average person, this meant stability. The money in your wallet was a direct claim on something real. The system functioned as a clear ledger, backed by a finite physical asset. But the system had a fatal vulnerability, and the pressure to exploit it was becoming unbearable. By the late 1960s, the United States began to strain the system it had engineered. Facing the immense costs of the Vietnam War and vast domestic spending, the government did not raise taxes, it printed dollars. A flood of paper promises poured out into the world, but the pile of gold in Fort Knox was not growing. Other nations began to do the math. They saw there were far more dollar claims than the US had gold to honor them. French President Charles de Gaulle called the dollar's status an exorbitant privilege and began to systematically test that promise, trading his country's dollar reserves for US gold. His government even dispatched a naval vessel to New York to physically take delivery of France's gold. The system was bleeding physical assets. The United States had two choices: trigger a brutal global recession to defend the dollar, or default on its promise. It chose to default. By the late 1960s, the United States began to strain the system it had engineered. Facing the immense costs of the Vietnam War and vast domestic spending, the government did not raise taxes, it printed dollars. A flood of paper promises poured out into the world, but the pile of gold in Fort Knox was not growing. Other nations began to do the math. They saw there were far more dollar claims than the US had gold to honor them. French President Charles de Gaulle called the dollar's status an exorbitant privilege and began to systematically test that promise, trading his country's dollar reserves for US gold. His government even dispatched a naval vessel to New York to physically take delivery of France's gold. The system was bleeding physical assets. The United States had two choices: trigger a brutal global recession to defend the dollar, or default on its promise. It chose to default. This was not a policy change. It was a structural break. The system was now irreversible. This new world of floating currencies, unmoored from any physical asset, created a volatile new instability. And that instability would require a new kind of financial instrument. With the hard limit of gold removed, the primary restraint on money printing was gone. The 1970s became a decade of stagflation, high inflation combined with a stagnant economy. Since that day, the dollar has lost the vast majority of its purchasing power. This loss of purchasing power became a persistent feature of the new system. Gold was now just another commodity, and its price, once fixed, was now volatile. This new, unstable environment demanded a new tool to manage and profit from this volatility. This is where finance began to diverge from the physical economy. The political decision in 1971 split money from gold. But the true financial revolution came in 1974 on a trading floor in New York. With gold's price now volatile, the New York Commodity Exchange, or COMEX, launched gold futures contracts. A futures contract is a deal to buy or sell something at a future date. But the real innovation was a single detail: cash settlement. The vast majority of contracts would never end in the delivery of physical gold. They were designed to be settled only in dollars. This allowed speculators to bet on the price of gold without ever needing to own it. The system now had a way to replace a real market for an asset with a paper market for its price. A second point of no return was crossed. The model was now scalable. This new contract was the blueprint for the abstraction of the entire global economy. The model is built on leverage. A trader posts a tiny fraction of the contract's value as margin, allowing a small amount of capital to control a massive amount of paper gold. This attracted a tsunami of capital from traders with no interest in physical metal, only in betting on its price. This mechanism fundamentally altered price discovery. For the first time, the power to influence an asset's price began to shift from the physical owners to the leveraged paper traders. Today, the volume of paper gold traded on a single day can dwarf the amount of physical gold mined in an entire year. The paper representation now overwhelms the physical reality. This model was so successful, it was copied for everything. Cash-settled S&P 500 futures allowed betting on the stock market without owning a single share. This is the same architecture that now allows institutions to gain price exposure to assets like Bitcoin without ever holding the asset itself. The 1971 break made gold a tradable commodity. The 1974 innovation built the machine to trade its price on an abstract, almost infinite scale. The machine was now built, and its architecture now underpins the modern financial system. This brings us to today. We are all living inside the system that began in 1971 and was scaled in 1974. A system where digital promises and leverage are completely disconnected from the physical economy. This system enabled the historic explosion of debt. With no physical anchor, credit creation has no ceiling. U.S. federal debt exploded from under $400 billion in 1971 to tens of trillions of dollars today. A debt load mathematically impossible in a system backed by a finite asset. This system's architecture creates deep fragility, most visible during repo market freezes. The plumbing seizes when layers of paper promises overwhelm the actual collateral. It leads to markets like silver, where hundreds of paper claims can exist for every 1 ounce of physical metal available for delivery. This is the source of a modern paradox. Your stock, your bond, your currency is an entry in a database, a promise of cash, not the asset itself. This is the legacy of 1971. Physical settlement was replaced with a promise, and direct ownership was often replaced by intermediated claims. This is why inflation evaporates your savings, and why paper wealth is created on a scale the real world can never match. The dominoes pushed in 1971 and 1974 have now all fallen. We live in the world they created, a world where the paper representation matters more than the physical asset, where the promise of cash is the foundation of the global economy. This is the operating manual for the present, a system built not on assets, but on promises. This system leaves us with one final unanswered question. In a world built on abstraction, what happens when everyone demands physical settlement at once?